Our guest this week is Peter Walker, head of insights at Carta. Peter is a self-professed data geek who publishes some of the most interesting insights and research on venture and startups today. We talked about which pockets of the venture market are going strong, why San Francisco is still the leader in venture, and why speed matters in VC. I really enjoy reading Peter's work, so I hope you enjoy this conversation. Peter, thanks for coming on the show.
Joe, appreciate the invite. Thanks for having me.
Well, I'm a big data nerd, and I've read a lot of your stuff, so this should be good and wonky. I'm excited about it.
I like geek as well. I don't know if you I self-identify as geek or nerd.
I prefer nerd, but I appreciate geek as well.
Indeed, yes. Well, from a fellow data nerd, then yeah, happy to be here.
Great. Carta has a treasure trove of data, a massive amount. Maybe you can expand on that, but maybe to get things rolling, what's the data that crosses your desk that you're most interested in, and you get it and you're like, that's the good stuff?
I think that happens actually with some regularity here, which I'm very lucky to be sitting on this, as you said, mountain of wonderful, interesting data. To answer the question up front, the stuff that I've been really fascinated with lately, I guess two things that have been fascinating lately. First one is fund performance and fund construction around VC funds. So we've been doing this data practice for 2.5 years now, but mostly focused on what's going on with companies, VC-backed companies. But we've started to then look into the other side of the house, which is what's going on with VC funds themselves. And so that's the thing where we're kind of trying to connect the fund performance and fund metadata down to the portfolio company level. And so seeing both sides of the venture ecosystem that way there's some pretty cool moments of connection. And then the second one, which is maybe more immediately accessible to everyone, is just this compensation data set that we have around what employees are making in venture-backed startups. And you can take that from the basics, which is salary and equity. You can also look at things like how is hiring trending? What are functions that are in or out of vogue? How do people think about remote work? Some of the stuff that you read about as the consistent conversations in startups, the advantage of my job is I get to bring, hard evidence to some of those talks. So that's pretty awesome.
Cool. On the fund performance side, can I throw something out for you to chew on as you do?
Absolutely.
I've read plenty of studies on venture fund performance. A lot of those use Monte Carlo simulations.
Yeah.
And I have a little bit of a beef with that because, well, I don't think there's inherently anything wrong with Monte Carlo simulations. And we've already wonked out here pretty quickly. So I promise this is as wonky as it'll get.
It's the earliest that you've mentioned Monte Carlo on your podcast, I bet. But.
It definitely is. But one thing that gets under my skin is there will be this range of outcomes across many different samples of startups. And they'll say, okay, if you had a portfolio of a certain size, you'd capture X amount of potential average churn. What gets me is that it doesn't reflect the underlying strategies of the managers involved. So, for example, you can have a fund with 100 checks that they write versus one with 20.
Yep.
You're not controlling for the fact that one fund is essentially being 5 times discerning and has 5 times as much time to add value to founders as another. I would be really curious to see, what the numbers look like when you're able to control a little more for the underlying strategy. So
yeah,
just a nerdy wish for Christmas.
But it's a fascinating topic. Portfolio construction is sort of an evergreen topic amongst VCs. One of the things that our data, not immediately, but hopefully can be helpful with, is teasing apart some of these strategies. Some of the more public data sets on VC fund performance, I think, are better than nothing for sure, but definitely skewed in the fact that they are primarily either FOIA requested SEC filings or self-reported data. And on the self-reported side, I think there's a whole host of biases that kind of crop up there. Where are you only reporting your good stuff? It's definitely leans towards the bigger funds as the people that make up the vast majority of those data sets in many cases. So one of the reasons why we got into the fund performance game, as it were, in the last only 2 months or so, is that our data set is not the whole ecosystem, and you have to take that with caveats, but at least we're not excluding things that are not going well. We're including the whole of all the funds that we can across, the vintage years that make sense. And from there, you can kind of build a little bit more of a level setting, reality based idea. But we haven't dug into bet check size as one of the major factors, or just number of bets written. You could also dictate by follow-on strategy, or just what industries these companies are in. There's a whole host of cool analysis left to do.
That is cool. I look forward to reading more about it. Maybe to bring it up a level, what do you see from the data about the overall state of play in venture?
Yeah, I mean, I guess it depends a little bit on your perspective. So if you were to simply eliminate 2021 as both in the data sets and from our collective memories, I'd say venture is actually in a decently healthy place. In comparison to the peak, we're nowhere near it. So that sense of change, I think, has become the standard reference point from where we were in the end of 2021 to where we are now. Collectively, that's $70 billion invested into Carta companies in the last quarter of 21 versus 21 or 22 billion in the most recent quarter here in 2024. So that's a massive drop. That's the change that everyone is dealing with. But if you look back to 2018, we're kind of steady. Maybe we're a little bit below where you expected, but nowhere near 70% off. So I think that sugar rush of the last boom time really is throwing people's game off. But overall, I think things are getting back to healthy. There's a bunch of statistics that I can reference where there's been improvement in the last couple quarters. So I'm hopeful that we're going back to whatever new normal is now. But a little bit of that comparison is the thief of joy mantra from me, and that we should just forget about 2021.
I'm curious to get you rolling on data from the last couple of quarters, because from what I've seen from you and from elsewhere, it's not necessarily that things are spiking, but it feels like there's a solid floor that's there, and maybe a rebound and some early indicators. Yeah. What are your thoughts?
I'd say for sure. So if we just run through a couple of the big ones, first off, just total funding up for the last 3 quarters. So from about 16 billion or so on Carta to end 2023 to 22 now. That is not a massive increase, but it is a steady rise quarter over quarter. That's good to see. Second is the point that is maybe the most illustrative is down round percentage. So what percent of all rounds on Carta are down rounds? At the nadir of that metric, when everything was an up round in 2021, it was like 5% of deals. And then it rose steadily until last quarter, or the quarter before last, Q1 of 2024, where it peaked around 25% of deals. So 1 in 4 deals were down rounds to begin the year, which is super high. In Q2, that was more like 17%. Not great, but definitely headed down. And in Q3 so far, that's been lower. It's been more like 13% or 12%. So that suggests to me that, one, the companies that can do a down round are like kind of biting the bullet. They looked around and said, look, we need to do this. We need to do a recapitalization. We were overvalued. And then 2, maybe the sad side of it, there are definitely companies who would love to take a down round right now, just no one is offering it to them. So do they go out of business? What's their next play, et cetera? So down round percentages is one that we track closely. And then the sort of other part that I think is useful is the natural objection to a lot of this data is, yeah, but what if you strip out AI? Isn't it just AI and like everything else is bad? I'm here to tell you that that's not true. Valuations for non-AI companies have risen both in Q1 and in Q2. So it's not solely an AI stories, though of course AI is a major part of it. There are different kinds of companies being built, and we're getting back to a slightly broader sort of swath of companies. Although, of course, I wouldn't walk into a meeting with a VC and not have some sort of AI story or an explanation why you don't have one.
What stage has probably shown the most strength over the past couple of quarters?
At the beginning, the downturn hit late stage the hardest. So the closer you were to an IPO, the more difficult funding has been, and just a total drop of capital. Seed and pre-seed held up relatively better. Well, we do see some real spike ups happening now in Series D and Series E. So I'd say over the last 2 quarters, the highest rate of change has actually been with maybe growth to early late stage. But in terms of how have different parts of the ecosystem held up in the downturn, basically the earlier you are, the more resilient it's been.
You mentioned in State of Private Market Report, the Q2, that 31% of startups that raised a seed round in Q1 2018 made to its Series A within 2 years, but only 15% of those in the Q1 2022 vintage have done so. Do you think a normal number is somewhere in between, or do you think a normal number is more back towards what that Q1 2018 looks like?
When you take a graduation rate, so what percent of companies that raise a seed round will ever raise a Series A? If you just look at it on an aggregate basis over the last 5 years in Carta data, it's something like 45 to 50% end up raising an A round. But many of them do that after the 2-year mark. But we think that 2-year mark is a good indication of like speed or urgency in the venture ecosystem. I'd say 31% is I'd expect it to probably be more like 25. About half will raise in 2 years or less, and half, maybe a little bit less than half, will raise after 2 years. I think some of those metrics were juiced a bit by the boom, but it's definitely 15% is definitely low.
On my data wish list, magic wand, I would be curious to know the outcomes and returns of the companies that graduated from a seed to an A within 2 years. And then those that graduated, they made it to the A, but it took longer than 2. And it'd probably take a long time for all that data to bake, but I'd be really curious to know. Do you have any intuition about which of those would be more interesting?
That is a souffle of a decade. Yes, that you're baking there. I think that, look, venture is a game of outliers. So I'm sure that there are companies that wander in the wilderness after their seed round by choice or not by choice, and then raise an A 5 years later and end up becoming fund returners. I'd expect that to be a lower percentage, though. I do think no matter what the current meta across venture is, I do think speed matters. And you would expect that the companies that are able, especially in this market, to raise multiple rounds quickly are doing something different.
Yeah, I tend to agree. Nikki from Blackbird was on recently, and he made the point of, if you look at the biggest winners in venture, there's a consistency of they tend to win a lot and they win very early.
Yep.
And it's just a common pattern. And you can find exceptions. You could take a Figma where they were baking the product for a few years out of public eye, but the reality is most true breakout wins, they're early signs of it, and they tend to get there quickly.
Totally agree.
And walk folks through what a safe is. And
we can start at sort of ground definitions here. So the safe is the simple agreement for future equity, created by, I believe, Wilson Sonsini and Y Combinator in tandem somewhere around 2013 or 2014. So a very young instrument, about a decade old. And it was created in distinction and contradistinction to the convertible note, which had been one of the primary ways for early stage startups to take in funding. The convertible note had 2 terms attached to it that would define how that funding would actually, how that equity would be delivered to the investor. So there's a valuation cap and a discount. And basically the SAFE has the same 2 terms, except the difference is that a convertible note comes with an interest rate, so it's actually debt. And the SAFE doesn't have an interest rate at all. It is a pure equity agreement. It's actually kind of a unique instrument in finance in general. It's effectively just a promise that this investor will get equity in your startup at some point in the future, but they're not going to get it now. And what it does is it allows the founder and investor to kick the can down the road a little bit on the valuation question, which is super hard. If you have a 6-month-old startup, what should that company be valued at? It's basically impossible to know, really. And so the safe allows both parties to push that conversation off until whenever you raise a priced round, and the founder gets cash up front and the investor gets the promise of future equity and can move more quickly. There are a lot of reasons why different flavors of safes may be in vogue. So this one we are talking about now is post-money versus pre-money. Originally, when Y Combinator created the documents, the pre-money was the default way to do it. It was actually the only document at first. And then about 2018, 2019, I believe, they added a post-money version. And now on Y Combinator, you cannot find the pre-money version. It's only post-money. Why did that happen? And why are people using it as the default? Effectively, what the post-money does is it adds clarity to the conversation. So if we take a step back and look at maybe an example, if you're investing $1 million into a startup on a pre-money safe, you as the investor don't really know how much of that business you're going to end up owning when they raise a price round. It's highly future dependent. So are you going to have 5% of that business? Are you going to have 50% of the business? It's kind of tough to tell. It probably won't be 5 or 50, but you get the idea. Whereas on a post-money safe, if you raise $1 million on a 10 million valuation cap post-money safe, the investor will probably own around 10% of that business. If 10% exactly if we exclude the option pool and everything else. So it adds clarity to this, what used to be a kind of unclear process. So that's a good thing. It's a bad thing for founders in that it's actually a more negative fundraising instrument for them. And the reason that is the case is because it favors investors over founders is one way to put it. Because alongside every post-money safe, if I, as Peter, go out and raise on a post-money safe from Joe, and you give me 500K, and then the next person comes along and I do another safe round, maybe for $1 million this time, you as Joe are not getting diluted by that second investor. You own your little slice of the pie no matter what I do on safes from now on. Whereas if those had both been priced rounds, you probably would have been diluted alongside the founder. So there's some anti-dilution built into safes that catch founders off guard. A very common thing for founders these days is to come to their seed round or whenever their first price round is and look at their cap table and say, I own less of this business than I thought I did because of the anti-dilution inherent in post-money safes. So that was a very long answer, but hopefully it gave you a little bit of a swath of what's going on with the safe.
Yeah, no, that's great. And I'm biased as a VC, but I think the anti-dilution element, to be fair to the people who drew it up, there's a little bit of a, I don't know if it's a carrot or it's a stick or it's a carrot on the end of a stick, but of nudging founders to, hey, listen, you don't want to keep diluting endlessly. You don't want to keep raising capital. And you do want to hasten towards doing a price structured round, which for the investor into a safe, you'd like to see sooner rather than later, and just kind of eliminate edge cases of those things not coming together.
So here's a question though, Joe. Why are VCs so willing to sign the second or third safe round? Because in my view, you're totally right. I would expect safes to have been sort of, restricted to this early funding round once, maybe twice, and then get off. But we see companies and VCs, institutional VCs investing into these rounds where they've raised 3 or 4 different safes on different valuation caps. So like, why are the VCs not pushing their founders to go to priced earlier?
It's a good question. I think sometimes it's speed or convenience. And in my experience, it's been founder led.
Yep.
So we've got one where founders twice raised at a higher valuation, like materially higher. The business is going really well. And both times he did it on safes. And I actually nudged him on the last one. I'm like, look, I think you ought to do a priced round here and just kind of clean all this up.
Yep.
And this, I'm talking against my own interest, but I think for the next one, I think it'd be good for you to go ahead and do that and convert everything. So yeah, sometimes I think the founder just loves the speed and convenience of a safe versus they don't like dealing with lawyers. If you're focused on, if your day-to-day grind is like the push towards product market fit and you get drudged into legal bills, redlining, That's not fun.
Yeah.
That's feels like a distraction. And so, it could just be that, or that could be part of the reason.
I think it's definitely part of the reason. Legal costs for price rounds have gotten, if you believe some of the anecdotes, pretty absurd occasionally. So that definitely makes a point. And then, of course, the speed. The advantage of the safe is you don't have to aggregate the round. You can have someone come in on a val cap and then keep working. Another month later, have someone come in on the same valuation cap, and it's easy and it's simple, as opposed to having to herd all of the investors into the same round at the same time. So I get it. I do think that there I would imagine there's maybe a slight groundswell coming from some VCs soon where they have investments like yours that have been marked up on safes a couple times. And how do I report those to my LPs? Are those actual markups? Do I change the way that I'm valuing this company? It's a confusing space for sure.
Yeah. I mean, for our valuation policy, we don't mark them up.
Yep.
So, and that could be incentive for a VC to nudge on, hey, let's go ahead and let's price this out.
Price this out. Right. I'd love to have a little bit of less of a stale mark on this company. Yeah, for sure.
It wouldn't hurt. What are investors and founders not talking about right now that they should?
What are they not talking about right now? I think there's I'm not sure that this is a under-discussed topic necessarily, but I find it very fascinating, which is like founder funding strategy. There was this meme or idea going around in venture probably 6 months ago or so that the right way to raise venture capital is to raise 1 or 2 rounds, 10 million or less, and walk away from VC and do venture light, I think is the term that many people were using. And I've seen a lot of founders say or attempt to do that, and they run into some structural problems, both VC incentives, and then also if you're building in a competitive space, maybe you're competing with some really well-funded companies. I feel like founders and investors sometimes don't talk about what is the total funding that this business needs. I know it's a wild conversation to have with a seed stage company because who could know? But I feel like founders kind of flip back and forth between fundraise as much as humanly possible to make sure that I am default alive versus I'm going to keep this incredibly light. And I don't know if I feel like sometimes the flip is happening because that's what they heard rather than that's what they plan on.
I've talked to founders who raised venture money and then decided to pivot towards trying to be profitable, focus on default alive, grow from there.
Yeah.
One thing I think a lot of founders, when they make that move, don't appreciate is that when they switch from focusing on hypergrowth to stability, the optionality that comes with hypergrowth goes away. And when they look at valuations after making that, big strategic move from we're focusing on not growth at all costs, but growing very quickly to we're going to try to get to break even and then grow from there. Yeah. It's just such an enormous reset on growth rates and valuation. I think that catches a lot of founders by surprise. And I don't think there's anything inherently wrong with it, but sometimes I'll talk to founders and they're doing that. And I feel obliged to warn them of, you're going to run into a wall with valuation.
Yeah. It's, and hopefully they've kind of just thought through the next couple of steps. But I agree that it's more difficult to start on one track and switch to the other, as opposed to just starting, with a single set of assumptions and kind of moving forward with those. So in some ways, I feel for the founders that began their companies in 2018 or 2019 and then had to flip everything that they were doing with that business when the downturn happened, as opposed to the ones that are starting now and kind of building with the capital efficiency as a mantra.
You put out some really good reports on venture across different ecosystems and geographies. Yeah. What have you seen in those numbers over the past few years? If you zoom out and look at trends across different cities, geographies in the US, what stands out to you as being most interesting?
I think there's 2 stories that are oddly both true. and feel as though they're in conflict, but they're really not, which is one, venture as a asset class is becoming more distributed, especially if you look at the earliest stage. So the way we talk about it at Carta is it's never been easier to start up anywhere across the US. And even fundraise from institutional VCs in a seed or even a Series A round. Like that can happen in Silicon Valley, of course, but it can happen in Charlotte. It can happen in Dallas. It can happen in St. Louis. It's happening more places. So that is trend number one, 100% true. And then oddly, the second trend is Silicon Valley has actually never been more dominant in startups as a whole. So this idea that there would be some sort of distribution that takes away the prominence of Silicon Valley from the startup ecosystem, when you look across all the capital and the activity, like it just isn't happening. Silicon Valley, if you combine San Francisco and San Jose as the two metro areas, takes in just as much share as they used to in terms of total capital invested. If you're looking at the AI boom that is centered squarely in the city of San Francisco, something like 50% of every dollar invested into an AI company is invested into a San Francisco company. So both of these things are true across, geography and venture, which I think is, it's fun for Twitter fights to say like the death of Silicon Valley or who's going to overtake SF. We're not seeing it happening.
Network effects are pretty powerful, awfully hard to kill.
Really difficult to
kill. If you take those two things that seem to be counter, but also seem to be very true, and you roll forward a decade, what does that look like to you?
Honestly, I think, let's use Miami as an example for this, which is everyone's favorite debate topic. Miami is super interesting because in 2018, there was no venture community in Miami, effectively, a little bit, but it was, quite honest, I think it was outside the top 50 places in the US, at least according to our data. Now, if you just take rounds under $1 million, it's sixth, which is a massive jump. If you took all capital invested, it's still in the, high teens, 20s, et cetera. So what is happening there is there was the pandemic. There was a ton of influx from, it started in Web3, AI, et cetera. There's other sectors now. And then there's a lot of investors that are hyping that up as the place to be. That has caused material changes to that ecosystem. If you project ahead 10 years, one of two things could happen. Either they continue to gain investors who can do the Series B and Series C, and they kind of broaden the scope of what it means to be a Miami company, or Miami becomes like a feeder city into New York or SF, where some of those companies start in Miami and then leave when they need capital that is just not available in their local ecosystem. So I think in some ways that these two trends, as you mentioned, network effects are really difficult to displace. If we're looking ahead a decade, I'm still betting on the home of startups being Silicon Valley. What I'm interested in is how do ecosystems that are not Silicon Valley build the middle and late stage? It's one thing to build the early stage. It's very difficult, but it's actually the easier task. How do you build the middle and late stage ecosystem in a city like Miami or Denver or wherever? That is a question that I don't know if everyone has good answers to.
What's a consensus view in venture right now that you think is BS?
That it's going to take materially less money to build a great startup in the future. I'm not sure how consensus that is, but I hear it a lot that, company costs are coming down for startups and they're going to, like anyone should jump in. I think that's true if you're trying to start a not venture-backed company. It's much easier to begin using some AI tools or whatever as a SaaS company these days that you don't think is going to be $1 billion outcome. I think that's true. I think for real venture-backed businesses, I don't think their need for capital is going to go down. In fact, it might go up.
Can you nerd out on why or geek out?
I mean, the easiest stuff is just that the competition is going to increase such that their need for capital as a differentiation would remain the same. If it's super easy to enter a space, how would you distinguish yourself? One. Two, AI compute costs, obviously a problem for super deep AI startups, but could be a problem across the board. And then three, there's a mix model coming for SaaS that is going to be real, like in an AI dominated world, how do pricing models work? I think that's a go-to-market question that very few people have answered or are even spending a ton of time on. And if there's a major shift in a pricing model like that and SaaS is still the biggest part of our startup ecosystem, I think having the capital to actually wade that out, if you've begun in the old world and need to move to the new world, will be incredibly important.
Peter, this is really fun conversation. I enjoyed going down these rabbit holes with you. If someone wanted to follow along with your work, what's the best way for them to do that?
Well, two ways. One, you can look me up on LinkedIn. We're, publishing stuff there 3 or 4 times a week, just little snippets. But if you want the good stuff, the real big solid reports and all, we're actually launching a new place for that on our website. So it's carta.com/data.
Awesome. Well, look forward to reading more from you, and thanks for coming on the show.
Yeah, appreciate it, Joe. It was a fun conversation.
Hi, Joe again. Thanks for watching the show. If you'd like more of this in the future, subscribe to our channel. If you'd like to learn more about Seaplane Ventures, just check out seaplaneventures.com. Cheers.